All right, y'all. I'm live. This is my first live. This is the first live I've done on YouTube. The Mortgage King live. Da-da-da-da. So I'm just reading off the screen real quick. Choose who can participate. Blah blah blah. All right, cool, man. Let's get right into it, y'all. Let's get right into it. So we're going into 2025. Where we're already in it, and I just wanted to kind of shed some light on some mistakes that we shouldn't be doing in 2025, right? Because we want to grow up and make sure that homeownership is possible. And so these mistakes aren't really talked about often. So that's what I'm going to talk about on the live. Some mistakes to avoid in 2025 so that you can make homeownership a reality. All right, guys. Now, as you know, I'm Giovanni Mirabad, the Mortgage King, and I've been doing mortgages since 2016. True story. You can check my my NMLS. See how long I've been licensed there. I used to be licensed in multiple states. Now I'm just licensed in Florida to do residential in Florida, but we do loans throughout everywhere in the United States. Doesn't matter the state. We do loans everywhere for investment properties. But yeah, going right into it, man. I've been doing this for a while, so if you're listening, pay attention. Paying attention is actually free. You don't got to take a loan out to pay attention, so just pay attention. Um, so if you go through like my Instagram or whatever, you've seen, man, we've been doing this for quite some time, all right, guys. So we're gonna get straight into it. The first mistake is not getting pre-approved before house hunting. Not getting pre-approved before house hunting. Man, this is something that I've been talking about for such a long time that sometimes I forget that people may have not heard me say this. And so I haven't said this in such a long time. Guys, getting pre-approved before house hunting is essential. Why? Because number one, you get to know your budget, right? You're not just spinning your wheels. You know exactly what type of home you want to buy, the price point for that home, and so you're also not you're saving time for your real estate agent who's going to be driving you around everywhere and wasting their personal gas, things of that nature, just to be showing you homes. You want to make sure you can actually afford those homes. um, and also, a big mistake that we see is people who start shopping for a home before getting pre-approved, falling in love with a home, and then finding out they can't qualify for it when it comes to the pre-approval, when it comes to the actual funds. They might have thought they qualified. Maybe something happened where, they went self-employed and they've been crushing it for 6 months and they've got all this money and they think that money won't be an issue or whatever the case is. Then they go and do the pre-approval and they can't prove that they've been doing well as a self-employed individual or a self-employed earner for the past 2 years, because that's their guidelines, right? Whatever the case is, you hadn't gone through the pre-approval process. You fell in love with the house for whatever reason, right? You put the carriage before the horse. You started shopping. You fell in love. Now, boom! What a bummer! You can't get the financing, or at least the financing that you were expecting. It's just not that, right? Getting pre-approved also, as far as time wasting, it helps to not waste time, not only just so that you know what homes to shop for, but when you do find a home, those sellers and the real estate agents who are helping these sellers, they like to see a pre-approval letter, right? They want to see that you can actually close on this house that you're about to get an offer accepted on. This strengthens your offer. So whatever offer you're doing towards the sellers, when you show them that you're good for the money, it strengthens that offer. All right. So I'm just going to keep on getting some water here because my throat is parched. I've been making phone calls since 8 in the morning. I just been non-stop, talk, non-stop, talk, non-stop, talk. As I mentioned, man, this is my first live. This is pretty good. And what I like to do is just give out content, man, and see how we can help people in ways that they don't have to pay, things of that nature, man, because getting a loan is so difficult. At least if you don't know what's going on or you don't have anybody on your team. So yeah, guys, first mistake, number one mistake is not getting pre-approved before house hunting. Make sure to get pre-approved before you start house hunting, before you start asking realtors to show you around, before you start going on Zillow.com or Realtor.com and looking at homes and falling in love with homes and setting these type of expectations that really all just balance on your pre-approval amount and can you actually get funded. All right, mistake number 2, guys, is overlooking loan options. All right, so that's mistake number 1. Mistake number 2, I have this all written down. Overlooking loan options, guys. So there's different type of loan types. There's FHA, VA, conventional. FHA is probably the most famous. The Federal Housing Administration. It's backed by the Federal Housing Administration, meaning you get to put, the lenders aren't scared to purchase an FHA loan because it's insured by the Federal Housing Administration. So even though you're just coming in with 3.5% down and it's risky because you didn't put enough down so where you got enough skin in the game, those lenders are okay with that because it's insured by the Federal Housing Administration. So if you ever wanted to not pay up or what have you, they're still protected through mortgage insurance backed by the Federal Housing Administration. That's why it's called an FHA loan. You also have a VA loan. The VA loan, those are for our vets, active duty, retired, what have you. VA loans are one of my favorite loans. They're just so good in just all aspects as far as rates go. They're backed by the VA the same way FHA is backed by the Federal Housing Administration. The VA loans are backed by the VA, and that's how they're able to get away with just 0% down. So it's 0% down, backed by the VA, no mortgage insurance at all, and I mean, there's just so much more. Credit scores go really low on these. There is no VA loan limit like FHA. There's an FHA limit, right? If your home is too expensive, you can't use an FHA loan. You can do that with VA. And you also have conventional loans, which is your most talked about probably. These are just regular conventional loans where you come in with 3 to 5% down. Right? You have a better credit score. You're probably going to get some really good pricing on that. Mortgage insurance won't be as much because your credit is excellent. And so that's what you're looking at as far as your conventional loans. Outside of that, guys, you also have non-qualified mortgages. And non-qualified mortgages are very unique in their way of getting people approved who thought they couldn't get an FHA loan, a VA loan, or a conventional loan. These loans work a little different. They're called the non-QM loans because they're non-qualified mortgages. That doesn't mean that these mortgages can't get approved or qualified just from the way it sounds. There's a different lingo between mortgage lingo and layman's term. Sometimes we take things a little too literal when we're listening to mortgage terms. So non-qualified mortgage, you might think that these mortgages don't qualify. But that's just a fancy way of saying that these loans don't conform. They're also called non-conforming loans because they don't conform to the guidelines of FHA, VA, and conventional. These include bank statement loans. If you have trouble getting an FHA loan, VA loan, or a conventional loan because of your income, it's probably because you're self-employed. Again, this is just an assumption, but this is kind of what the story almost ends up being all the time. You're self-employed, you didn't show or you had a lot of write-offs on your tax returns because your CPA thought they were doing you a favor, and your net income at the end of all of your deductions is like $500 or somewhere in the negatives, but it's very low income. So you can't qualify with an FHA, VA, or conventional loan because if you're self-employed, they're using your tax returns to represent and show what it is that you make on income. So they have bank statement loans on the non-QM side, non-qualified mortgage, non-conforming side. These are your bank statement loans where you have a little bit of a higher credit score, and you want to show them what your deposits look like into your bank account, and that's what they're going to use to calculate your income. That's the non-QM sector. So overlooking your loan options is one of the biggest mistakes. So the people who come in, let's say they're self-employed, they, for whatever reason, didn't qualify for an FHA loan. They didn't know that there was other options available. You got to make sure that you know your options. For conventional loans, you have you can also put 3% down. So there's different options. You have to understand what your options are, and then you can make a decision based off of all the information that you get. You just want to make sure you're going in the right avenue, and the way to do that is by not overlooking your loan options. All right, that's mistake number two. Mistake number three. Mistake number three is ignoring credit health. Guys, your credit, man, it's got to be, especially in this society, in this kingdom, uh, those three little credit bureaus, they run the show for everything, man. Even if you're trying to get whatever kind of funding, because in this society, you need funding. Um, if you're trying to start a business, there's a reason why they have that statistic of, I believe it's 80% or 90% of businesses fall or fail on their first year, something to that degree. I forgot what that statistic is. Most likely, those businesses are failing because of funding. In this society, guys, you need funding. If you need something done, you need funding. Your very first house, you needed funded. Your very first car, you needed funded. Maybe you bought a car that you owned, just like that's something my brother used to do. He bought like $2,000 of iron, and then he called it a car, and he drove it around. But anyway, everything needs funding. Credit is so important because you need funding. You should always keep your credit where it needs to be. Guys, ignoring your credit health is detrimental. We're not going to do that in 2025. We're going to pay attention to our credit. Have everything on auto pay if you can. Pay everything in full. Just be hyper focused on your credit. Stop being so like nonchalant about your credit, because if you really want to succeed and do things in this world, you're going to need good credit, and you're going to need funding. You want to start a business? What are you going to do? Work your tail off, save up a bunch of checks, and then go open your business with all the money you save? No, that's nonsense. You work too hard. That's your money. What you should do is just get a business loan, right? And you need to do that with good credit. Anything you want to do, man, you guys are going to need good credit. Let's pay attention and stop ignoring our credit health. We want to stay underutilization as much as possible. My key thing, here's the Mortgage King key thing. My key thing, whenever I use a credit card, I'm going to pay that puppy in full. If I can't pay it in full, I'm going to do everything in my power to not use that credit card in that situation. Maybe you have to use that credit card. All right, go use that credit card. But now try to make it a thing where you have to pay that puppy off. And if not, just stay on top of it like a hawk, man. Stay on top of that. Do your minimum payment. But keep your eye on that thing and keep working until you can pay that thing off. We just want to keep an eye on our credit, guys. They say utilization under 30. I say less than 30. Just always show that thing paid off. Just always show that thing paid off, man. Utilization is a huge thing. Lates, guys, if you have lates on your credit, you're going to have to do your absolute best to get those lates out. Contact the creditor. Do what you got to do to get those lates out, man. And even if you got to call the actual credit bureau, see what you got to do to get those lates off. If you got to wait 2 years before they fall off, then go ahead and do that. But we need to be hyper focused on our credit scores, man. For real, those FICO scores, they're so detrimental. The entire aspect of life is basically held by this thing called a credit score, man. Everything you need to do, you need good credit. I'm telling you that right now. So in 2025, mistake number 3 is we're not going to ignore our health credit. Come on, man. All right, guys. Number 4, not budgeting for closing costs. Come on, man. How many people actually understand what closing costs are? How many people even heard of closing costs? This is one of the things that surprises first-time buyers the most, is when we start talking about closing costs. They'll contact me about down payment assistance, right? Typical first-time buyer. Hey, do you have any down payment assistance programs? Yeah, we do. We can cover this much. Or if we just talk about down payment, after we discuss down payment, maybe they're getting an FHA loan, 3.5% down. It's about, let's just say the down payment is $13,000. They'll say, oh, all right, do you have any down payment assistance programs? Because really, I just have saved about $2,000, which is fine, man. Nice work. But yeah, I do got a down payment assistance program. Now he's probably thinking, that's awesome. Now I can qualify for a home because my down payment is covered. Not so fast, man. Not so fast. Why? Because you have closing costs. Now, closing costs, it doesn't all have to be paid by you. but it is your cost. The closing cost for you to close is your cost. How you get those costs paid, that's a different story. You want to get a seller credit to pay your closing costs, you can do that. If you want to get a gift from a family member to help pay your closing costs, you can do that. Those are your closing costs. All right. So you got to understand what closing costs are, not budgeting for it. What I typically do, guys, I'm from Miami, Florida, and our closing costs, they always say to estimate closing costs from 5 to 6%. And I never do 5 to 6%. I always find the sweet spot is about 4.5% to estimate your closing costs, because your closing costs are things that need to be paid that are outside of your down payment. Things like your appraisal, your inspection, your title company fees, uh, whatever those costs are that are outside of your down payment, those are your closing costs. And I would always estimate it to be about 4.5% of the price of the home that you're buying. That'll give you a good estimate. It's a little bit on the higher end, but I would always say to shoot for that number to estimate your closing costs. That way you're prepared for what's to come. And if the numbers get better, then all right, awesome. But just use 4.5% as a budgeting for closing costs. That's mistake number 4. And mistake number 5, making major financial choices during the mortgage process. Oh my gosh, guys, come on. Large purchases, job changes, avoid all that, man, especially the large purchases. What are you doing financing a new car while in the middle of the mortgage process? What's going to happen is most people will think that that's not a big idea, or that's not a big deal, because you've already been pre-approved, you're already in the underwriting process. What's the deal? Every time your credit gets ran, the lender is going to get a notification from the credit bureaus that your credit was just ran, because you're in the middle of the process, and they're doing a DTI calculation on you, a debt to income ratio calculation on you. And so that whenever your credit gets pulled, they get notified so that they can make sure you're not taking out more debt while in the middle of the mortgage process. Because if you are, they're going to have to include your new debts to see if you can still qualify for the mortgage with the new debt. You understand? And so sometimes that can mess with your approval process. Maybe you're doing good, you take out a Jaguar or an Excursion, whatever it is, and now that monthly payment is messing with your debt to income ratio calculation. And in the middle of the process, you can't qualify for a home anymore. All right. So definitely avoid things like that. Not just that, also the credit pool. Sometimes people are in the middle of the buying process and they think, yeah, my debt to income ratio is very healthy. But if your credit wasn't too good and now you just got your credit pulled, your credit score changes, that can also be a potential uh, declination in your mortgage process, because it might just shoot you right down. So if they'll see that you get a credit pull, they're going to get the notification. They're going to ask you if you take out any new debts. You say, yes, I did. They're going to say, awesome, send us the information. They're going to update your your credit report. And if your updated credit report comes back and your credit score is low, that could potentially disqualify you. So you just want to avoid large purchases, anything financial, job changes for sure. That includes going from employed to self-employed, or self-employed to employed, whatever's going on. You just don't want to do that mid-process. All right. I've had a lot of situations earlier in my career. Now I do this thing out where I send out the pre-approval letters with the 10 commandments of home buying, and it tells you like 10 things to not do during the process. But before that, it's happened plenty of times where large purchases, job changes, divorces, just whatever, anything big, middle of the process can actually get your loan declined completely. So avoid that. Avoid making major financial changes during the mortgage process. All right, that's what we're going to do. All right, guys. So that pretty much concludes the five mistakes that I really want you to avoid in 2025. The 5 mistakes I really want you to avoid in 2025. Let's crush it, guys. 2025 is going to be the year that you get all your questions answered. You're going to feel confident in the home buying process. You're going to feel confident in getting your money put into real estate that grows with appreciation. even if it crashes, it's only going to go up again after the crash. Look what happened in 2008 after the huge financial crash that everybody always talks about, where there was mad foreclosure everywhere you went, and the homes depreciated, and everybody was getting foreclosed on or whatever. Those homes dropped in value. Today, those homes are worth triple, quadruple from 2008. That's just what's going to happen. I mean, look at the homes that the crash of 1920, right? The Great Depression. Homes dropped in value during that time too. Those homes that were around in 1920 compared to now, I mean, dude, the value's ridiculous. So even after a crash, real estate goes up. Let's make this your year, guys. It's the Mortgage King, man. So if you need to reach out to me, go ahead and do that. This is my first YouTube live. Let's see how it goes. Let's see how it goes. Anything you need, guys, reach out to me. You know, I'm very transparent. I'm gonna give you honest advice. And that's just what it is. So Mortgage King. Dale.